Today's topic is a bit unique, but I think it's timely given what's gone on over this past year. We're talking about short squeezes and whether you should buy a stock that is heavily shorted. Let's jump right in. First, we need to understand what a short squeeze is, and to do that, we need to understand short selling. Short selling, or selling short, is simply the opposite of what we normally do when we purchase shares. We're all used to buying shares, hopefully at a low price, and then at some point in the future, selling at a higher price. And when we short sell, we actually want to do the same thing, except we're going to reverse the order. We want to sell high today and then buy back for a lower price sometime in the future. And that's really all that's involved. I have to borrow the shares, sell them, and in the future, buy them back, and then return the shares. There's fees and interest involved here, but that's the simple process. So now let's apply this to a potential short squeeze. Let's say there's a stock that has a lot of short interest, meaning there's a lot of short activity going on. A lot of the shares are being borrowed to short. Now, let's say something happens and there's good news that comes out from the company or they report positive earnings. Then what can happen is there's some buying pressure, and that buying pressure, as we all know, is demand that can send the stock price going up. At this point, there might be a lot of people who've shorted that stock that are wanting to buy back at that lower price, but now that the price is going up, it's causing greater losses for these short sellers. There might be stop losses that get triggered, or some of these short sellers might hit margin calls, which requires that they close their position. And remember, in order to close a short position, you have to buy the stock back. And what does that do? If I buy the stock back, that creates more buying pressure, which then sends the price even higher. That triggers stop losses and margin calls in other people's accounts, and this continues to add more buying pressure, and that stock price continues to go up. It goes up and up and up until it reaches an unsustainable level, and eventually the stock price will come down, but that does not prevent enormous losses from occurring for these short sellers and for anyone who's holding the stock straight up. They're long those shares. They're making incredible profits if they're able to sell at those higher prices. And it's a bunch of craziness, but this is a very real phenomenon, and it happens maybe a little bit more often than some people think. Probably not as often as the investors in Wall Street bets think, but it does happen with relative frequency. In order to have a short squeeze, you need the right ingredients and you need a catalyst. Just like with a thunderstorm, not only do you need the heat and the moisture, you also need that catalyst. You need a lifting action, bringing that air mass up to create that thunderstorm. And same is true with a short squeeze. Yes, you do need high short interest, but that's not enough. You need that upward price action that's going to bring that cascading short squeeze and all of its components started, get everything going in the right direction. You need those stop losses to trigger. You need margin calls to trigger for all these people to be required to close their position. So again, you can't just have a high short interest and voila, you're going to have a short squeeze. You also need the right catalyst. You need those chain reaction of events to occur to start that short squeeze. One of the myths that I hear pushed out by influential YouTubers in the financial space is that all short sellers are evil, rotten people. They're just the worst kind of investor, and all they ever do is lie and spread misinformation. And while some of this does exist, that is the exception rather than the rule. Short sellers actually provide a service. Sometimes stock prices get completely detached from reality. The stock price might be flying high, completely disconnected from the intrinsic value of that company. And by shorting a stock, short sellers are actually helping to make markets more efficient. They're bringing that gap between where it's currently traded and intrinsic value. They're narrowing that gap, helping to keep markets more efficient, which is actually a service for investors, and it's a good thing. Hundreds and hundreds of stocks are delisted from the stock market every year, and many of these are shorted successfully by hedge funds. And remember, hedge funds are not the enemy here. You can't just short a stock down to zero. There is a company behind every ticker symbol. And if the company is healthy and doing well, if it's profitable and it's growing and it's perfectly fine, then the stock isn't going to go to zero. The short seller didn't make the stock price go to zero. They just identified that mismatch between price and value, and they were able to capitalize on it. Short sellers, again, I repeat, are not the enemy. And by the way, hedge funds and other institutions that have the ability and the capital to short a stock with such volume that it is able to move the stock price, these institutions don't just wake up one day and go, man, I just want to short sell this company. They've done hundreds and hundreds of hours of research, and they have many dozens of pages to support their short thesis. And by the way, these funds don't short a stock when they think it's just 5 or 10% overvalued. They're taking on these positions when they think the stock price is grossly mispriced. And on average, who do you think is going to win over the long term? The hedge fund who's got dozens of pages of due diligence and objective market analysis, or the Wall Street Bets investor who all they've got are rocket emojis and comments of to the moon and other confirmation bias on Reddit. I'm not telling you to avoid making a long-term investment in a company with high short interest, but having high short interest should not be a reason to be proud of owning this stock. One, having high short interest does not guarantee that a short squeeze is going to happen. And two, if you do own a company with high short interest, it should be a bit of a red flag. You need to understand why it's shorted in the first place. Again, institutions don't randomly short stock. They always have a reason for doing so, and you need to figure out if it's for short-term reasons or if over the long term that institution thinks that the stock is going to go bankrupt or their stock price is going to go to zero. You need to figure out the answers to these questions. If you've made it this far in the video, thank you so much for watching. Don't forget to like the video, comment down below, and consider subscribing. Until that next one, peace.